Hi, everybody. This is Paul Hitchcock with Wealth Protector TV. Really fired up to have Russell Barnett with us. He was one of our great tax professionals. Very timely video because we're talking about correcting a mistake on your federal tax return. And so obviously the season just ended. Russell, what's going on with this?
So there's a number of ways that you can correct a mistake once a return has been filed. The most common, of course, is an amended return. So the IRS helpfully keeps track of everything that's reported to them by a third party, such as a 1099, a W-2, etc. And their computers will automatically go through, they create a transcript of those reports, and they compare the transcript to what you reported on your tax return. So one of the ways that we'll either discover a mistake and correct it would be that the IRS will send out a notice. It's called a CP 2000 letter because that's the number at the top of the right of the corner of the letter. Sorry. And then that'll say, hey, we think that there may be something missing on your return or maybe a mistake. And we'd say, okay, here's what we think is missing. And then they ask for you to respond to it. So most commonly, this is a form of audit. And so not one that people consider typically to be an audit because you're not going in front of an auditor and being asked a bunch of questions, but still they're comparing their records to yours and asking you to explain any differences. So, and then through that process, you can actually make an adjustment to your return. Sometimes you'll agree with what the IRS is proposing, or sometimes you'll say, no, that's not right. Here's the actual correct answer. And then they'll either most often agree with whatever we're saying, assuming is correct, and then make the adjustment that way. So the one thing about doing a correction that way is that they don't look at your state return, they only look at your federal return. And so oftentimes if you're in a state that has an income tax and a tax filing requirement, once you've agreed to the changes to the IRS, or come to an agreement rather on what those changes should be, if there are any, then you would need to file a state tax amendment as well to know that. There could also be a circumstance where you just on your own discover that there's a mistake, and that then you can proactively file an amended return as well. And the amended return just tells the IRS or state, as the case may be, that, hey, this is the return that was originally filed. We've discovered that these changes need to be made. Here's an explanation of them. And these are the adjusted figures. There's a difference of either a balance due or a refund in, if it's a good mistake, right? So.
Right. Well, if your taxes are due on X date, and then there's a mistake and you need to amend it, do you get dinged with penalties and late fees if you have to?
You can actually. So anything paid after the due date of the return is subject to late payment penalties and interest, of course. So it's best to correct a mistake sooner rather than later. The IRS also does have information sharing agreements with, I think, most states. California, I know that California and their IRS will talk. And if they do make an adjustment, either through an examination or through a letter, letter process, like we talked about a minute ago, they will notify the state that the change has been made, and the state will make an assessment accordingly. So it is always in your best interest to find the mistake and correct it as quickly as possible if it results in a balance due. Now, if it results in a refund, then it's also in your best interest to get that refund as quickly as possible. So we do want to stress that, the IRS has only 3 years from the date that you file a tax return to make an assessment of additional tax in general, right? And so generally these CP 2000 letters come out within a year of filing a tax return if there is an issue where they think something might be missing. California, in particular, will allow up to 4 years to make that assessment because they primarily don't do these audits on their own. They usually just get the information from the IRS. And then you can see, well, the IRS has 3 years to make an adjustment. Then the California has an additional year to learn about it and make a following adjustment to their side. But the sooner you discover it, the sooner it gets fixed, the sooner you either get your refund or that the interest expense is minimized. So
Awesome.
Usually sooner is better. So.
Awesome, Russell. You are a fountain of knowledge. These are great. So thank you for jumping on the show, and we'll look forward to having you on again real soon.
Likewise. Thanks, Paul.